Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Make sure to hit that subscribe button for the latest market news. Now, a lot of uncertainties in the financial markets as we approach a crucial Federal Reserve meeting. The big question on everyone's mind, how will the Fed's decision impact the trajectory of the markets, especially with mixed signals coming from recent earnings and economic data? As we stand, the major stock indexes are showing modest gains, hinting at a cautious optimism among investors. Now, we've seen tech giants like Microsoft steadying ahead of their earnings release, while the broader market anticipates the potential ripple effect of the Fed's future policy here. Now, these moves come at a time when global economic cues from oil prices hitting specific technical levels to gold and silver appearing, quote, perky, as our next guest says. Now, it's painting a complex picture for commodity investors. To dissect these developments and understand what lies ahead for stocks and, of course, commodities, we have Tom Fitzpatrick, Managing Director at RJ O'Brien. Welcome back to Kitco, Tom. Great to see you.
Thanks a lot, Jeremy. Thanks for having me.
So we talked a little bit about just before coming on camera, we got news coming at us from all different angles here. And of course, as we're navigating a critical period with the FOMC decision looming, we got big tech earnings on deck. What are you watching in the markets that could tip investor sentiment, one way or another post-Fed announcement here, Tim?
Well, I guess we're watching everything, to be honest. But yes, I mean the Fed announcement, is still fairly important. They won't move tomorrow, mainly because they like the idea of giving guidance, and they haven't guided in terms of that. But I think there's every possibility they're going to guide towards September, as possibly the start of an interest rate cutting cycle. And the feedback loop of that, can be twofold. I think markets on one side will probably like the idea that the Fed is ultimately coming down on a decision in terms of easing and possibly an easing cycle. So on the day, it wouldn't be surprising, especially given that they've so far at least traded quite poorly today. The equity market might actually quite like that if that's what actually delivered. But I think there's that kind of time element between which the idea of interest rate cuts and lower interest rates are something that the equity market takes solace in, to why the Fed is having to cut, and what the backdrop is likely to be, and whether or not that ultimately turns out to be a negative for equities. For us, we've been very focused on a little bit of that similar path, which we saw in 2000, actually, where the equity market had done extremely well in 1999, continued higher in 2000 as the Fed tightened rates up to 6.5%. But the data began to deteriorate as we moved out of the summer of 2000. And therefore, the equity market had a wobble in July, virtually the same as we're having now. In fact, the equity market turned down on the 17th of July 2000, which is exactly the same day we turned lower in this down move that we've been seeing. Ultimately, we got about a 7% down move in the S&P. We got about a 14% down move in the Nasdaq. But it recovered again then into September. And then as it became clear that the underlying backdrop and data, and in particular, and I think that's going to be one of the big things that's going to be important, the employment data then deteriorated, as there are signs it has been doing now. Then the equity market began to get a lot more concerned, and we saw a more sustained move lower. So I think there's probably still, as we move into the middle of and out of the summer, a fair bit of choppiness to be seen in markets. For now, the equity markets are soft, but if the Fed does deliver on pretty much a commitment tomorrow, that should, I would say, in the short term, probably give a little bit of respite.
Yeah, interesting. I mean, we're always looking at their guidance here, especially their dovish comments. I mean, we got these conflicting recent earnings for some of the big Mag 7 companies. There's still much to come on that front. But if the Fed does shift its stance tomorrow, maybe doesn't, do a rate cut tomorrow, but they say, okay, September's coming up. Talk to me a little bit more about the immediate impacts that you see on the market behavior, especially in tech stocks that are sensitive to these interest rate changes.
You would think, and especially given where we are, we've just hit the low, as you've probably seen in this down move in terms of the Nasdaq. Even more importantly, when you talk about the Mag 7, and in particular, obviously, a couple of companies that are part of that, we've seen, very poor performance in terms of the SOX index. In fact, we have a danger of a bearish outside month there, something we haven't seen since January of 2021. So there's no doubt that they've been under pressure at this point in time. And as you say, they are interest rate sensitive. And a positive dynamic from the Fed, I think, should probably provide a little bit of a respite there. Obviously, depending on what earnings come out, that can also be important. But if the Fed, they won't guarantee to deliver in September, but if they guide towards that being their base case, it would be surprising that you don't see some sort of at least short-term relief in terms of those equity markets. And it's not just about tech, as you say. Some of the beneficiaries of this downward movement in interest rates we've been seeing have been things like banks, particularly because the yield curve has steepened a little bit, and of course utilities, who are very tied to what we see in terms of yields. They've been performing well, and while stocks and Nasdaq have been moving lower, in fact, utilities have actually been breaking higher. Bank stocks are testing, what were some fairly good levels in recent rallies. So you're definitely getting at the moment this kind of little rotational element. But I would expect if the Fed reasonably commits to deliver tomorrow, that we would see a situation where, at least in the short term, having come down the amount we've come down, we'd see some respite for things like the Mag 7 and the technology stocks in general.
Yeah, it's been such an interesting time, to say the least. Okay, well, you highlighted a critical juncture of WTI oil. I was reading your notes this morning. I guess it's touching some significant support levels here. Elaborate on the potential market implications if oil breaks past these levels, just because I think it's important for the audience here to understand, what a big economic indicator that WTI oil price is.
Yeah, exactly right, Jeremy. Some people, just think of it as a traded commodity, but it's more than that. It's an economic asset, probably the most important economic asset. There's almost no aspect of economic activity that isn't going to evolve around the oil price. So I think there are two things to look at in terms of that feedback loop, as you say. The first is, what is oil likely to do? And at the moment, it's certainly looking very likely that it could actually continue to push lower. But even more importantly, in a way, is to look at why it's doing it. Because whether it's a supply or demand driven effect is an important feedback loop in terms of what that likely means, both for the economy and for markets in general. I think it's hard to argue at this point in time that the downward move in the oil price is coming from some massive increase in supply. And therefore, you start to look more at the very poor performance we're seeing in the Chinese economy, the poor economic performance we're seeing in Europe. Germany came out with its GDP numbers today, and they've gone back negative again. These are two of the largest economies in the world, and clearly under pressure, and Japan not a million miles behind. So at the moment, the US has been holding up, but again, look at our numbers. Our last GDP number was 1.4% in the first quarter, I should say. Was a better number second quarter so far, but with a lot of inventories driven in there, and clearly some of the data coming out of the US is actually arguing that maybe the economic picture is not as bright as the headline numbers might suggest. And that's important, because if oil is moving down simply because of increased supply, that's just putting money in people's pockets in a good environment. And therefore, as a consequence, it's very stimulative. But if it's coming down because the global economic picture and potentially the US economic picture is slowing, it's still positive, but its feedback loop in terms of markets is not necessarily the same. And it's not just oil. I mean, you just need to look at the Bloomberg Commodity Index or a number of commodity indices. You need to look at industrial metals, even look at softs and grains. And commodities are essentially getting pummeled. And it's very hard to look at that and perceive it as some sort of positive dynamic that is there in terms of economic growth. Where it is a positive dynamic, of course, is it takes increasing pressure off the Fed to react to the non-inflation side of the mandate. And that's why employment is becoming such an important factor here.
Yeah, and certainly starting to see some cracks there. I mean, you just mentioned it though, Tom. There's this subdued reaction to what typically would be bullish drivers in the market. So, what does it indicate? I mean, what's the bigger picture here?
I personally, the bigger picture, I think the bigger picture that it's indicating is one that actually the economy is slowing. We're seeing it in a lot of the indicators. We're seeing it in the ISM indicators. We're seeing it in some of the confidence indicators. We're seeing it in the hard data. If you look at the economic surprise indices, we're missing on a lot of pieces of data relative to expectations. So I think what it's telling you is the US economy held up a lot better than most of the other global economies. And a lot of that was the huge fiscal stimulus. A lot of that was people being able to get very cheap mortgages, businesses to get very cheap financing, a savings rate that actually at one stage went to 32% of disposable income. But all of those things have gone away. And therefore, I think what it's telling you is that a lot of the buffers that were holding up both the US economy and the US consumer are beginning to drift away. Even when you look at employment data that seems on the face of it good, like non-farm payrolls, you see we're creating part-time jobs. We're creating in hospitality and services. We're creating in government. So we're creating government and part-time jobs. We're creating low-paying jobs. But you're seeing a situation where initial claims and continuing claims are moving higher. You're seeing a situation where the unemployment rate, most importantly, is moving higher. And I think that's telling you that, underneath the hood, we're in a very complicated world. You said it earlier today. And I think in that respect, you need to look at more than the headline of a number. You need to look at the guts of the number. And what we're seeing is that in a lot of these instances, the guts of the numbers are not looking so positive. So that's the concern when you come back to markets. There may be some sort of knee-jerk reaction to a dovish Fed and to lower interest rates. But if there's a point in time and things you want to look at in that respect, or if the yield curve starts to bull steepen, and historically, if you see 2-year yields in the US invert to the Fed funds rate by 140 basis points or more before the Fed starts cutting, that historically has tended to be a very bad scenario, periods like 1989, 2000, 2006. So that means 2-year yields with the Fed funds at the moment at 5.5, getting to 4.1% before the Fed cuts. Well, we're at 4.37 just now. We're only 27 basis points away. And if the Fed gives us some dovish type of bias, we could be pushing towards those levels before the September meeting. And historically, that has been a very good warning sign that the economic backdrop is worse than the Fed is allowing for, and that the Fed is actually behind the curve when it's making its first cut.
Yeah, interesting. I mean, there's so many analysts that are basically saying they are behind the curve. I talked to people all last week looking at the economic data saying they need to cut in July. We might not see that. Of course, Tom, we were talking a little bit before about gold and silver. Now, you run technical analysis on a lot of this, and I read that if gold surpasses that 2432 level, and I think you mentioned silver at 2857, there's some analysis here. What would the implications, though, with these metal prices, as we talk about commodities and metals, be for mining stocks or maybe related ETFs?
Obviously, if these underlying instruments move higher, that should be positive. But there's a bit of a double-edged sword here. As we've often seen, when you get a negative risk environment, even gold and silver sometimes come under pressure simply because anything that's owned often gets sold. But on an ongoing basis, if you see a scenario where this environment creates that lower level of yields, possibly even a little bit of weakness in terms of the dollar initially, then that is an environment where gold and silver would traditionally do well. Also, we can't completely ignore situations like the fact that we hit a US debt of $35 trillion, which, if I'm not mistaken, is about $106,000 per every taxpayer and $106,000 per every man, woman, and child, and about $260,000 per taxpayer. That is a huge debt burden, which is also going to look even worse if we are to go into an economic downturn. And in that instance, I think that is where you would expect gold and silver to actually shine. So in this environment, if we are moving lower in yields, if we are seeing a slowing in the economy, if ultimately we see equity markets come under some pressure, absent it moving into some sort of crisis type of scenario, that seems to be the setup that will allow gold and silver to come back. As you said, we've had a correction here, as we've had in a lot of markets. We've had a bit of choppiness, I think, because people have owned gold, have owned silver in this move up. And when you suddenly get hit on your equity market positions and you suddenly get hit on your other commodity positions, often you have to reduce risk. But I think the backdrop at the moment still seems quite favorable for both of those to push higher as we go through the second half of this year.
Yeah, interesting. I mean, another tool that people often go and hedge against is Bitcoin. They use it, and your analysis suggested that there's a bullish formation starting to form here, similar to last year's pattern. What key price levels should investors watch to confirm this bullish scenario here, especially as we watch it pull back?
Well, I guess yesterday we saw that the price, or what looks to be the price level, does seem to be the price level. That level just shy of 71,000. We got within a few dollars of 70,000 yesterday, and we came back down quite strongly. And as we both know, the volatility in terms of Bitcoin and crypto is often why people would prefer to go to something like gold and silver, which has a reduced volatility environment. But nonetheless, people do get involved in terms of that space. That space has become also part of the political spectrum. And I suspect as we move closer to the election and we see what the outcome is going to be, that's going to have some influence. But I think, it is once again beginning to have that look of that kind of digital gold in a way. And there is a generation of people that really believe that that is, a better financial market hedge than necessarily gold and silver they have been historically. So if we start to go through that, 70 to 71,000, it really looks like we're breaking out again, as you said, somewhat like last year. And a breakthrough there would suggest that we could be starting another move that, very conceivably in a period of, possibly fourth quarter of this year to first quarter of next year, could literally see Bitcoin possibly trade above that magic $100,000 level.
Wow, that would be nice for a lot of people looking for those levels. Okay, what kind of cascading effects might that have on the broader tech sector if that does happen, especially, fintech firms that are increasingly intertwined with crypto, while these earnings might hit a little bit of a soft spot?
I do think, I think the days of crypto maybe driving markets as much as they did in the past are not the same today. Therefore, I don't think that in itself would be the driver, although it's something that should be looked at. I think the underlying backdrop is going to be more the driver. And also, quite simply, sometimes in markets you get to a point. I mean, if you look at the moves we had last year, if you look at the moves we've continued to have this year, even with this, wobble that we've seen in markets, we're still looking at, Nasdaq stocks up more than 13% and SOX index up even more. It's really a market, I think, that has, it's ironic. In 2000, one of the biggest hypes for market was Y2K, and it never actually happened. And then a week and a half ago, we had, almost the equivalent of Y2K in terms of the large technology failure. And I think we've front loaded a lot of AI expectations as being the new thing in terms of these markets. So I think the danger is if these markets come down, it's just simply a function of their own excess. Simply a function of the magnitude of the moves. We've gone so far, so fast. And as a consequence, the danger being that a lower interest rate structure won't necessarily help them. The danger being that actually any signs that the economy might be struggling might actually hinder. The feedback loop being that maybe, some businesses are suddenly saying maybe we can't afford to be as aggressive investing in the AI revolution right now as we have been. So I think it could just be a function simply of market forces, and a potentially slowing economy might be more important for these indices. As I said, we are in danger of getting a monthly reversal on the SOX. Whether we get it or not, we'll actually see, obviously, when we close tomorrow. But we only need to close below 50.60, and we're way below that. I'm not saying it will repeat, but the last time we got a monthly reversal on the SOX at the all-time high was January of 2021. And we ended up in that instance going down 49% over the course of the following 10 months. So I think there are definitely warning signs there. Sorry, I should say January 2022. There are warning signs there that the market is very stretched, led by all of those companies that are in, and all of those companies that purport to be in AI, a little bit like every company in 2000 that had .com at the end of their name. went up the minute they mentioned that they were creating a website. Now a company just has to use the word AI, and the stock might go up 100% overnight. So I think it's just an excessive market, and it's important because you and I both know that it's these stocks that have driven the whole market. It's not like this move has had breadth. It's actually been driven by a very small number of stocks. So you only need that small number of stocks to come under pressure, and it can have quite an impact across the broad market.
Yeah, well said. Okay, before I let you go, we were talking a little bit about this current yield environment, particularly in US, and you're watching Germany too. Then, what you're observing in the earnings landscape. Are there specific sectors or stocks, kind of getting back to what we were talking about before, that you believe are positioned here to do particularly well for some significant movements with what we're seeing?
I mean, I think if we're going into a scenario where we're getting a slowdown, of course, things like, staples, necessities versus discretionary will probably do well. But in terms of the interest rate structure, we've already talked, I think, a lot about the technology side, and I think there are other factors at work. But the two sides that tend to actually like a scenario of lower interest rates, and in particular, if it's a scenario of lower interest rates with a steepening yield curve, in that instance, banks tend to like that. Their funding costs are going down, the yield curve is steepening. So if we get a bull steepening in the curve with a downward movement in interest rates, I would say financials and high quality financials, they should potentially benefit from that, albeit that if it turns into a significant economic slowdown, there will be concerns on the other side. But initially, they should be a beneficiary. And boring though it sounds, we still seem to have that relationship between utilities and interest rates. And when we see interest rates move lower, you tend to see utilities move significantly higher. And that is what they've actually been doing. So I think staples, banks, unless and until we see a situation where the feedback loop seems to be one of a very negative economic effect, if we see yields move up, if we see the curve steepen a little bit, should do well. And utilities out of this should do well as well. I would be more cautious, even though there was an initial rotation into things like, the Russell 2000 because of the perceived domestic effect. That has waned a little bit recently, and it could wane a little bit more if there are increased concerns that it's actually the domestic economy slowing down that's causing some of these moves.
Yeah, so much narrative to bust through. Should investors be thinking about balancing their portfolios right now in this? Are people taking profits and just saying, okay, let's start fresh?
I think you should. I mean, at the end of the day, if you have a situation, if you think about it, if you have a situation where you're right, and you hedge yourself a little here, I think that's going to serve you well. If you have a situation where things are still okay, then you're not in a 0% interest rate world anymore. So it's not exactly a disaster in a 2 to 2.5% inflation environment to be sitting in a money market account that is now actually paying you 5% plus rather than the 0 to 25 basis points. So it therefore really only becomes a little bit of an opportunity loss if you're wrong, but you actually still make gains. You just don't make the same type of gains that you would make if you were still in the market. I think when a situation like that presents itself, when there are some red flags flying, and you can actually be defensive and still find yourself earning relative to inflation and not bad income, I think it would be foolhardy not to be taking advantage of that.
Yeah, well said. All right, well, we covered a lot of ground today. Tom Fitzpatrick, Managing Director at RJ O'Brien, unpacking it all for us. Thanks again for coming on, my friend. We'll keep an eye on the FOMC and have you on for a little update here as we continue to watch the economic data.
Excellent. Thanks again for having me again, Jeremy.
Thanks, Tom. I'm Jeremy Szafron for all of us here at Kitco News. Thank you for watching. Lots of market news we are watching, so stay tuned for the latest updates. Hit that notification button, and we'll see you next time.